Hello everyone, welcome to the Hummingbot channel. Today we're going to talk about hedge, what it is and why it is important for both traders and market makers to understand what is and how to make use of hedging their positions on the market. So let's first begin. Quick disclaimer, everything I say here is for instructional purpose, education. So as always, do your own research. There is no investment advice here. What is hedge? Hedge is an investment that is made with the intention to reduce risk of adverse price movements in an asset. Normally, a hedge consists of taking and offsetting positions in a related security. The whole idea of the hedge is that you have an asset. It could be stocks, it could be cryptocurrencies, it could be any kind of assets. And to protect yourself from price movements on the opposing direction that you are positioned, you create a new position on the opposite direction. Let's take a quick example. How exactly would a hedge work? So we have here on the left, you can see the spot market, the price on the spot market, and on the right, the price of the perpetual markets. Pretty much usually they are the same price. There is some market difference that allows some arbitrage opportunities, but that's another topic. If I took a position here at this price on Bitcoin, and after some time, price move up and reach a point where on my view from my analysis from the market, from whatever is the information I have, I am not sure what's going to be the direction at this point. It could be up and I keep winning, but at the same time, as market is, it could also the price could also go down, start to sell off, a lot of things could happen. So at this point in time, I have a position, but I'm not sure what will be the most probable direction of the price on the market on the next move. What do? I need a protection for this, right? So I need to take some time to see what happens on the market. Could sell the Bitcoin I have, the assets I have, realize, wait and see what happens. Or what I could do, I open opposite direction on the future, right? So in this case, it's the same size at a different price. In a practical sense, what happens here is that I lock it a profit of 4K. Doesn't matter what's the direction the market takes from now, right? Because whatever is the direction, my net profit is locked. So I'm definitely not taking any risks due to price movements. Price can go up, price can go down, doesn't matter, my net profit is still at 4K. So a quick example here, how this, the calculation that goes behind this. What happened is, let's say if the price goes up to 60K, my buy position, my spot position here, have a profit of 9.6K, but my sell position on the perpetual market went down, I lost 5.6K. If you add them, the result 4K. If the price goes in the opposite direction, goes down to the Bitcoin price goes to 40K, I lose profit. My loss on my spot position is minus 10.4. But on the future side, where I sold, I entered a short position, I have a profit of 14.4K. At the end, the net profit, no matter what's the direction of the market, I am always locking up 4K as a profit. There is a few possible ways to do the hedge. If you don't want to lock itself the profit, you cannot maybe not open a short position of a full contract, a full Bitcoin. You can open 0.5 Bitcoin. So you're saying, let's say, yeah, okay, the market could go down, but there is a good chance the uptrend continues. So instead of making a full hedge, I could do half a hedge, right? So if it goes down, I lose, but I don't lose as much as I would if I only had the spot position. So why do we hedge? First reason will be I want to lock it. I am profitable, my initial position. I don't have enough information to take a decision, and I want to see what happens next. So I'll make sure that right now I lock it my final profit. For whatever reason, I can take a decision later. So I can completely exit, close the short position and sell the asset. So I exit the market totally. Or I could just later just remove the hedge and if the price, if the uptrend continues, remove the hedge and keep surfing the uptrend, right? Another reason, reducing trading fees. So usually that's not always the case. You always have to check with the exchange what are his trading fees on each market. But usually the spot market costs more than the derivatives market. Example I took from Binance. If you plan to keep this position for a longer time, if you buy, you're paying 0.1% fee, right? If reach a point and you want to lock the profits and you exit the position, but you plan to enter it later after whatever happens, show up a clear direction where the market is going. If I sell the spot, I'm going to pay 0.1% fees, okay? But on the other end, if I just make the short, I'm paying less to build this short to get this protection. The execution trading fee is smaller usually, but you also have to remember that if at some point in the future I'm going to close the structure, this hedge structure that I built, I'm going to pay both fees. So let's say this will be the cost of doing the hedge. Right? From the execution perspective, it could be an interesting reduce the fee at the moment you are executing, because back to the spot, if I buy it, I pay 0.1. If I sell the spot, I pay 0.1. If I want to enter the market again with the same size, and I'm going to pay 0.1 again. So if I'm just do the hedge, I'm paying 0.04 to open the hedge and later 0.04 to close the hedge. So in an essence, I'm kind of reducing 0.02% of the account, right? Always have to consider what's the kind of position, if it's a short term, if the idea is to hold the position for a very long term, maybe it will be cheaper if you do the hedge instead of just selling the spot, right? Another reason to make the hedge, well, you can have these assets on a different place, right? They might not be liquid or available at the moment when something happens on the market, when there is a big movement on one direction, right? So let's say you can have this asset on a saving account, you can have this asset on DeFi, lock it on the DeFi protocol, which in the case of DeFi would mean that you would have to pay gas fees to remove the position, gas fees to transfer the position, gas fees to transfer the position to exchange if it's going to use centralized exchange, or gas fee to execute the trade if you're using a decentralized exchange. So it's probably a good idea if you want to protect your gain, but that asset is locked somewhere else. You won't have to pay all this whole transaction to take the chance to make the hedge. Also, you can include in that the timing, the time it takes to make transfers between one place to another. So if it takes too long, what could happen is that the moment your funds arrive, we're going to close the position to make the sell. The price already changed. It's a whole different situation, and you have to take a new decision. So it's a good way to protect funds and assets that are in other places, locked in other places that can be moved immediately. Another reason is that you could use the hedge to create structure, position itself. Price of the position doesn't change. You're not gaining or losing, no matter what's the direction of the price. But this allows for you to receive some interest on that position. So the two examples I have here, we have an options cover call, where this is not that common in cryptocurrencies, but on markets, for example, on stock markets, you can have the stock and you can protect that stock by selling a call on a higher price or a lower price or whatever price you want. And that means that you receive the premium from the option, and since you're selling an option, and at the same time, you lock it up the profits if it goes on one direction or another. Okay. So options is a bit more complicated to create hedge structures, but we are not going to cover this today. The option here will be the perpetuals funding rate. If you have traded at some point in your life on perpetual markets, you know that every set of time, some exchanges do it every 8 hours, some exchanges do it every hour. There is an interest funding rate that's paid depending on what's the balance, what's the direct, how many people are on each side of the trade. What's been happening usually is that short positions on perpetuals generally are the ones that receive this interest rate. Long positions pay, short positions receive the interest rate. So what you could do, you could take your spot position and create a hedge on a perpetual and for some time, and over the time you will be able to receive that interest rate with, in a general sense, practically zero risk, right? Because no matter the price movement, remember your net profit is still the same. The most important for this specific video is that is used by market makers to reduce their inventory risk. That's one of the main goals looking from the market maker perspective. Why hedge is useful for it.